After 2 turbulent years of deep recession and extreme recovery, we expect 2022 to be the year of normalization with regards to policy mix, economic activity and inflation. The new year should see slowing growth and inflation as inventories turn from headwinds to tailwinds. There is also a genuine chance of hitting a fiscal cliff while major central banks simultaneously engage in a new cycle of highs. All of these factors will likely provoke volatility in the markets and trigger large dispersions across and within assets. The good news, in our view, is that current expectations for monetary policy and earnings growth incorporate too much inflation and too little growth. On the central bank side, it is crucial to acknowledge that the best days of monetary accommodations are behind us, and that it will not be supporting financial markets in 2022. But in our view, the end of easy money is not the end for equities, although it could weigh on activity more so than inflation. Our proprietary US growth nowcaster, which tracks and synthesizes US growth in real time through a large spectrum of economic data, tends to decline on average by 0.35 in the 12 months following the first hike. In the end, we are far less sanguine about the magnitude and duration of the upcoming Fed rate cycle than what the market is currently pricing, given the potential pitfalls awaiting in 2022 and our belief that the Fed will much rather err on the side of caution than aggressively hike rates. If history is any guide, the path to normalization will be shorter and shallower than most, including the Fed, currently expect. This in turn should be beneficial for growth-oriented assets in general and equities in particular. We have identified 2 possible negative scenarios that may prove us wrong. The first one could be a new tantrum, where the scale and pace of monetary normalization would be greater than what is already priced in. This could be the case if inflation continues to surge. The combination of higher rates and quantitative tightening could lead to the same market action that occurred in 2018, a correlation shock. The second alternative scenario could be one where COVID may continue to linger and spawn even more dangerous variants than the ones we have so far experienced, which would put us back to square one, with lockdowns and restrictions regenerating massive fiscal and monetary stimulus to combat deflation and massive defaults. While 2021 was the year of reflation morphing into full-fledged inflation, we doubt that 2022 will cascade into stagflation, as many market observers and participants may fear. Rather, we see a gradual deceleration of growth and inflation, induced by easing supply constraints, which in turn should lessen the pressure on central banks to hike as aggressively as currently anticipated. History also shows that US equities and the US dollar generally benefit in the first 12 months of a new rate hiking cycle by the US Fed, and we believe that this time around will be no exception, especially in light of the very short and shallow upward path that Fed funds are likely to take. In this context, we currently have a preference for quality segments in equities that offer solid earnings growth and higher visibility in terms of profitability, US equities versus the rest of the world, a long stance on US dollar that should benefit from stronger US GDP. Finally, we will be less exposed to real assets than we were in 2021, as current pricing in both inflation break-evens and energy prices reflect a durable expansion period in the global cycle, which in our view, given the potential headwinds identified for next year, is now too optimistic.